Welcome to The Informed Investor, where we break down the latest financial headlines, bringing in research and insights to help you separate the news from the noise.
Welcome to The Informed Investor, a show brought to you by Dimensional Fund Advisors, a global asset manager bringing financial science to investing. Today's topic is assessing manager performance. I'm Mark Ochner. I'll be joined today by Wes Creel and Jake DeKinder. And I guess the topic being assessing manager performance. It's also maybe some considerations you also want to bring into the evaluation of a manager in addition to just performance. We'll dive into some of that here today. Any thoughts, though, as we get into it?
Well, it's not just the performance, it's the why and understanding that, because then I think that helps you form appropriate expectations going forward of, are there ways to add value and are things that, all else equal, detract from adding value.
Yeah, what I love about the fund landscape in general is just that it's so much of a demonstration of some of the principles we've talked about in the past with well-functioning capital markets, prices that are loaded with information very difficult to outguess. It sets up this set of predictions that show up quite a bit in terms of the fund data.
One other point I'll make on that is it's interesting as we get into this, when we look at the performance of some of these areas, I think we'll touch on this. Why does it still persist within the industry? Mm-hmm. And I think that's important to unpack.
All right, well, that's a great intro here to some of the headlines we want to start with. So let me read these headlines, then we'll dive into it. The first one, what short-term fund performance tells us about future returns? And then the second one, how smart people screen for funds. Now, in this case, we're talking about funds, we're talking about mutual funds, we're talking about ETFs, both on the stock side of things as well as on the bond side of things, right? So, hey, one of the things that we're going to be referring to quite a bit here is what we call here Dimensional the fund landscape, the mutual fund landscape. Mm-hmm. No, it is the fund landscape.
Fund landscape.
It's got a D on it is fun. There's a lot of great graphics in it, but it's fun.
Fund landscape.
On that point, though, you said mutual fund, and we used to do the mutual fund landscape, but I love the fact of the work that you've done pulling in a lot of the ETF stuff, and you see similar results.
Yep, so we've expanded it to the fund landscape, mutual funds and ETFs. And that goes back to several years ago we started this just to see how our managers doing relative to their benchmark. So maybe give us an overview of the fund landscape, how we go approaching that in assessing managers.
Yeah, and like you mentioned, we've been doing this for more than a decade now. So we originally set out to look through the data to see we have a belief about the power of markets and how competitive it is, how challenging it is to outguess markets. Well, that should imply that you shouldn't see widespread evidence of managers being able to outperform benchmarks. You would probably expect a paucity of funds that are able to outperform. And sure enough, that shows up in the data when you look over 10, 15, 20-year horizons. Very few are able to outperform prospectus benchmarks. But even beyond that, I think one of the things that surprised me, and you made a good point earlier when you talked about the connection between the mutual funds and ETFs where we see some of the same outcomes, was the lack of survivorship. How many funds were around? I mean, just in the equity space alone, you had 2,800 funds or even more that were around 20 years ago, and less than half of them are still around today. And so you think about, okay, yes, underperformance is probably a big part of that, but there's other characteristics that we know that can drive investment outcomes that can kill these funds over time.
I think it's a good point. I mean, a lot of times when we're out talking to financial professionals, that's one of the points we really hammer on is this idea of the survivorship. Because you're right, the performance is one part of it, but from a financial planning standpoint too, I mean, if you have more than half of the funds that are closing down, that's problematic for you.
It's a good point to make about what that survivorship means, because if you're trying to assess what is a possibility of me picking a outperforming manager going forward, the relevant opportunity set or the relevant sample to assess was what was available, say, 20 years ago. It's not funds around today that have been around for 20 years because you're going to have potential bias built in, what we sometimes call survivorship bias, where the fact that they were around that whole time probably means they were on sort of the right side of the return distribution or had performed better than the average fund, which is why they lasted that long. And so I think that's one of the challenges for investors.
Well, also, I think you bring up the challenge that even if you're on the right side of that distribution, it's a question of is it true manager skill or is there some luck that's involved? And I think we can get into some of that you've seen that over time where you get some long runs of really good manager performance, but then sometimes those managers that did really well can almost turn on a dime and have horrible performance. So then it's a question of, did they somehow lose their skill, or was maybe the first run a little bit of luck that was baked into that?
Well, in the document we're going to allude to here, the fund landscape, the audience out there can go find this. It's publicly available. Just search Dimensional Fund Landscape, and you'll be able to get access to some of the numbers we're we're going to be mentioning. But Jake, go back to your comment there about sort of this desire to go find the best managers. It seems to be always there as an investor, and I say always there meaning going back for decades, that that's what you did. You find the smartest, the most well-educated, the hardest working, and somehow that should translate into success. And by success, my ability as a manager to outperform my respective benchmark. But I think one of the first studies ever done in evaluating manager performance was back in the 1960s with Michael Jensen. And I think those results, you saw a pretty large number of managers underperform their benchmarks. Yet that quest kind of keeps continuing for decades.
Well, I love the fact you brought up Michael Jensen and that really, I think, the first big study on mutual funds. And what's funny is if you go back a little bit before that, you didn't even know how well your manager was doing because we didn't even have any data, right? We had nothing to even analyze,
computers.
Which is wild to think about, right? But then we get some data, we're understanding this, we're looking at manager performance. And you're right, back in the 60s, we realized that most of these managers didn't perform as well as the market. So it does kind of bring up the question of, we've seen this through the decades, we've seen continued manager underperformance. Why does the idea of stock picking, timing markets, trying to outbeat markets through mispricings continue to persist? And I think it's part of human nature. I mean, in every other aspect of your life, really, the harder you work, the smarter you are, the better you can do. And when you go to investing, more often than not, it's really the opposite and can almost get you in more trouble.
But I think that's the challenge, is extricating how much of that was by chance alone, which we know that's going to be a pretty large range of outcomes, versus actual skill. There was another great paper, not quite as far back as the Jensen one, but probably more than 15 years ago at this point, from Fama and French, where their big contribution was actually simulating what the luck-only distribution would look like. If you took skill away from all these managers, it's basically a coin-flipping exercise. How big is the range of outcomes? And then once you have that, you can assess how the actual distribution of fund returns look. And it was interesting that it looked very similar to the by chance distribution, but just shifted to the left, worse, really by the fees and expenses. And so that, combined with the fact that you might hear a great story from this manager on why they outperformed, I think that story is very compelling. But as we see in the data continuously, that doesn't mean that they're going to continue to outperform going forward.
Love the fact you said their story may be compelling. And I think on previous episodes we've said this, but a lot of this industry is almost more of a marketing industry than an investment industry. And you come up with a good story, you package it well, you market the heck out of it.
Yeah, what can be sold rather than what's in the best interest of an investor. But let's dive into the data here. You mentioned 20 years in assessing managers. What are some of the results you found? What percentage of managers beat their benchmark for stocks and bonds?
Yeah, it was not many. So if we go back 20 years ago, so you got a little bit over 2,800 equity funds, you got a little bit over 1,600 fixed income funds, and then the survivorship rates in both cases were a little bit less than 50%. So I mean, more than 50% of these funds are dropping out, either through a liquidation. Sometimes people ask what happens to these funds. They can either be liquidated, where it's returning capital to investors, or merged with another strategy. Frankly, I'm not sure the merger is that much better, because it could be the case that fund gets merged with another investment style, or a different style of the management process. Maybe goes from fundamental investing to pure quant. So in that case, you might get something you didn't really plan to sign up for. And you can go beyond that. I mean, you have 18% of the equity funds that started that 20-year period both survive and beat their respective benchmarks, 16% for fixed income. So the deck is stacked against you, right? And I think that's to the point of the power of markets.
Well, and also I love the fact you brought up fixed, because, a lot of times people focus on the equity, they focus on the stock side. That's some of the numbers we're quoting there. But, you look at the fixed income markets, there's a ton of trading that's going on there. There's a lot of information in prices. And the idea of identifying mispriced bonds, predicting where interest rates are going to go, all of these sort of same things, it shows up in the fixed income markets as well. It's really hard, if you take this approach, to outperform your benchmark.
All right, so let me look at those results and say whether it's 18% of stock managers, only 18% beat their benchmark. But as an investor, you might say, well, what do I care? I'm not buying the 18%. I'm not buying the 82%
Yeah, exactly.
bad managers. I'm just going to buy the 18% that are the good managers. So how do you guys think about just going after that strategy? Just buy the winners.
Yeah, and that's what I would do based on my own inclination. But the team runs a related experiment, which was looking at the persistence. And so they rank all of these funds within their Morningstar categories, accounting for the investment objective, ranks them into quartiles, looks over consecutive 5-year periods and says, of the ones that were in the top quartile in the first 5-year period, how many of them stay in the top quartile in the second 5-year period? So it's interesting when we look at this experiment that the average rate of remaining in the top quartile is a little bit less than 25. It's 23% in the data through 2024. So again, this is exactly what we would expect out of a competitive market, and I think it just illustrates the challenge of using prior returns to evaluate managers.
But I do think that's something that a lot of investors take as an approach is I just go by the ones that have done well. But you're just telling me it's really a coin flip. Some will do well, some will do poorly going forward. You just have no idea. And there's really no evidence to suggest which one will continue to do well and which ones will do poorly after the fact.
Well, I think it's indicative of how, we're talking about in the case of one fund's track record. And this is why when you're looking at prior returns, you want to have a little more nuance to it. Because let's say I look across managers' suite of offerings and they span different investment categories, U.S. small value, emerging markets, fixed income. And if they have a wide body of work of outperforming benchmarks across all those categories, that's indicative of a process. Unlike having a star manager, a process is repeatable, and that means you might expect some of that performance in the future. Not a guarantee, but a much better indicator than one fund's track record.
It's a little bit of key person risk too. I mean, if you're in this one fund and for whatever reason over a short period of time it's going well, and either they change up their strategy, the person goes on to something else. I mean, anytime you've got key man risk versus a process-based approach, you're probably going to be better off over time. And I love what you said across an entire suite of solutions at a manager versus just one sleeve, maybe one portfolio manager.
Well, there are a couple characteristics or maybe criteria you can look at for a respective fund that gives you some indication of subsequent performance. And Jake, walk us through some of those. I mean, fees is a big one where the fees align with performance in the data in the fund landscape.
Well, I love that in the fund landscape that we've looked at, right? Because we'll basically take all of these managers that you cited here, sort of everything that's available to a U.S. investor. We'll break it up into quartiles, and we'll say sort of what's the median expense ratio of low all the way up to high, which I think, by the way, it's right around 80 or 81 bips for the median of the low quartile, which, as we always joke, is not low. It just happens to be the median.
And that is over a 20-year time period.
And that is over a 20-year time period. But you see it when you look at sort of percent that outperform their benchmark and percent that underperform their benchmark. When you go from low to high, you see more outperform in low and less outperform in high. And there's nothing special that's going on there except for there's only one spot where that money comes from, and it's the return that investors take home.
Yeah, you're building in a headwind for yourself. It's like anything else we do in life where the more our costs are up front, the more of a hurdle we have to get over to really find a net profit from it. So I think it's really interesting when we look at the performance, the rate of outperformance conditional on the ranking on fee quartiles. You do see a monotonic drop-off in the rate of outperformance as you go from the low to high side. So it's, when you think about, okay, what can I make sense of out of the fund landscape? Well, one thing you look at is what characteristics are associated with different levels of underperformance, and certainly fees are one of them.
And those are published. And by fees, we're talking about the expense ratio in this case. But there's also another set of costs that aren't necessarily published, which gets into the trading costs and the magnitude of those. One way to measure that is looking at the turnover of a fund. How much are they buying and selling on any given year? And we see a similar relationship on turnover to fund performance as well.
Yeah, it looks very similar to when we rank on fees. The higher the turnover is, and that's, like you mentioned, a proxy for the trading costs that they're going to be incurring, the lower the rates of outperformance. And again, it's another way to think about what are the costs you're embedding as a hurdle that you have to clear even before you can at least match the benchmark.
The other thing too, which we don't have time to get into today, but we have done some episodes on sort of taxes and distributions and those type of things too. Like, you got to be careful. Are you looking sort of pre-tax or are you looking after tax as well? Because when you've got a lot of trading that's going on there, maybe you're not thinking about tax efficiency. Now what you really walk home with as an investor can be even lower.
Yeah, absolutely. I'm going to give a couple of numbers here just to give context to turnover so people know what we're talking about here. So turnover, and here I'm just going to keep it short here and just talk about some of the stock funds. But on that first quartile, the median turnover rate over 20 years was 25% turnover. Over the fourth quartile, the highest, the median was 125%. 125% says you have bought and sold everything within that year, and more than that.
On average, security is staying in that portfolio for less than a year. That's pretty high turnover.
Yeah. And then the 25% says, hey, I'm selling a quarter of my funds. So you might hold something on average 4 years. Okay. Just wanted to give some context to when we're talking about high and low turnover, what those numbers might mean.
I think it's an interesting commentary when we talk about all these aspects of costs. One reaction investors might have when they look at the paucity of active funds that are able to outperform is, why even play this game? I'll just go find the cheapest thing possible. But there's issues with that as well.
Well, there's a lot of issues with it. I mean, this is really, we talked about sort of, you got the traditional active management. We talked about computers coming on the scene. We run some of the first studies. Then you start to have sort of the conversations in the late 60s, 70s around indexing. And this is really the birth of indexing. And we've seen it grow in popularity. But I think what Wes is bringing up is that this idea of, well, if these managers can't do it, let's just go buy the lowest cost option. As we say, be careful on that, because I hear all the time, well, indexing is low cost. It's like, whoa. It's low fee in terms of the expense ratio. It may not actually be low cost when you really understand all the cost of implementation and what you might be giving up.
It gets back to me the philosophy of the manager,
Mm-hmm.
right? It is the goal, the philosophy for an index fund says, hey, I'm not even going to try to beat its benchmark. I will try to represent that pre-cost, but then after cost, you're probably going to be underperforming the benchmark. Or an active manager. Their goal is to outperform the benchmark through identifying and mispricing, which I liked how you said that earlier. We just went through the results. Results are incredibly low, though, for that goal. But let me read a couple of headlines here, kind of going back to the philosophy of a manager then, and your point about the indexing. So one headline here, the hidden costs of passive investing, which a lot of people call indexing. And then the second one, active management's persistent failure as it applies to performance. So we've already addressed the active manager one there, but just expand a little bit more on some of the challenges that an indexer has, an index manager.
We talk a lot about this around here at Dimensional, this idea of reconstitution, sort of like the index is going to determine what goes in, the index is going to determine what goes out. The manager's job is to track that, buy the same stuff at the same time, same quantities at the index, right? And the problem with that is that when you have very little flexibility and you got to basically you're forced to buy and sell certain stocks, you may not get the best price, and that shows up into the returns that you actually walk away with as an investor.
And it's not unlike if I have a traditional active manager who thinks that they found something the rest of the market is not onto, and they got to get their trades in immediately to make sure that information doesn't get leaked out before they take advantage of it. Well, it's a similar set of binding constraints around index fund investing potentially, where if you're an index fund manager, you're buying and selling based on whatever the changes are to the indices in accordance with the index providers. So, again, that can lead to higher cost per unit of turnover. So in that case, low turnover actually might not be low cost. But to your point, when you have a lot of people who are buying and selling these securities simultaneously, we could be pushing prices in a way that it's not going to show up as a cost. It's not in the expense ratio. It's in the actual returns of the indices. And so even if you're an index fund manager who's nailing exactly what the benchmark is doing with zero tracking error, you still built in a downward pressure in terms of the returns.
Well, and you get into the details too. It's also, do you really want to hold every single thing that might happen to be in the index? Or are there some stocks or bonds within there that as you understand the research, you understand sort of where you have higher or lower expected returns, you can make some adjustments to the portfolio that might help you do a little bit better over time.
All right, so let's go back to the subject of this particular episode, assessing manager performance. Some key takeaways for me on the conversation. It's incredibly difficult to outperform the market over long periods of time for the reasons we talked about there. There are some things as an investor you want to be sure of when you're considering different funds, mutual funds or ETFs. Obviously, the expense ratio is important. Understanding of what that turnover historically has been for that particular fund is incredibly important as well. And know the manager's philosophy. And so I would encourage anybody listening out there to do a search on Dimensional Fund Landscape, and you can get the document that we're referring to here and see some of those numbers in greater detail. Anything else you guys want to add to that conversation?
Nope, love it.
All good? All right. With that, everybody, thank you for joining us today. And as we round out 2025, the next episode is going to focus on some of the headlines as we go into the new year in 2026. Thanks for joining and have a great day.